All right, so in the return, you need the holding period return. So just remind you of the formula of that ending market value minus beginning market value plus income divided by beginning market value. So remember that income, you got to remember which dividend date you use. We'll talk that with your team. You can't look it up. Then you got to do the arithmetic average, which is just the sum divided by the number. And you annualize. You just multiply by 12. Then you do the geo average, which is I remember that holding period return. I can't type letters, but raised to the 1 over the n minus 1. And then you annualize. You do that, then you raise it to whatever the period is, 12 or 26 or 52, depending on what you're doing. So those are the formulas that you need. Then on the annualized, you have to put the footnote. So that's the whole problem, all right? So I'm reminding you, so hopefully a few people on your team watch the video so you have some practice. So your team's going to give me one answer, so I'll work on this together. This is practice for the final. All right, so this is where y'all can take advantage of the video I'm sending you. I'm giving you the answers to everything. You should start getting ready for the exam, so practicing the problem in advance. This is really a pretty simple problem. So you've got September, October, November. So September, the beginning market value or the ending market value is 155.86, beginning is 153.62. The income, which income do we use? Which month gets the income? You always do the X date. So November gets the income. So no income there. Divided by 153.62. The next period, you take 150.04 minus 155.86 plus there's no income. Divided by 155.86. And then the last month, 132.31 minus 150.04 plus you get $1.12 divided by 150.04. And then you do the arithmetic average. Here, pretty simple, 0.0146 minus 0.0373 minus 0.1107 divided by 3. And then you annualize. It's going to be minus 0.0445 times 12. And then you put a footnote. See if they institute. It's not allow annualizing periods less than years. So you're not actually supposed to do that. And then the geo, a little bit more work. Here's where you want to set up the formula and use it twice because you're going to need it twice. So 1 plus 0.0146, close parentheses, times 1 minus 0.0373, close parentheses, times 1 minus 0.1107. That entire thing, you're going to need it twice. You're going to need it for the geo and for the annualized. And here we've got 3 periods. So you do 1 divided by 3 minus 1, and it has to be lower than 4.45 loss. If it's not lower than negative 445, you know you did something wrong. And then when you annualize it, you do the same thing, except for instead of the 1/3, you do it to the 12/3 because it's monthly data. This one can be greater than or less than the annualized, but on the monthly, you can't. And you have the same footnote there. So it took me 2 minutes. So it's not a real tough question. You either know it or you don't. How important is this? Probably 98% of Americans have no idea what their portfolio is making. If you ask them, they made a lot of money. In reality, they've lost a lot of money, and that's what research has shown. Most Americans think their portfolio is making money when it's actually losing money. So probably important thing, we're doing a very simple holding period return, assuming there's no cash flows, buying and selling securities during the month. So it does get more complicated. But the basics is like, this is the basic approach. All right. We'll probably have to do another one because it didn't look like anyone watched the video, but we'll practice a little more. I can. Well, we'll probably be doing it again when we practice for the final. Yeah, there's certain things as finance majors you just know, and you need to know this. It's pretty important how to calculate a return. We normally do the internal rate of return approach, which is even better, but a lot of finance students don't know how to do that either. So it's important to know these kind of basics finance, including how to value a bond. So this you shouldn't have had what we just did in 3013, but this next thing you should have already done in 3013. So let's refresh your memory how to value a bond. So when you value security, it's the present value of future cash flows. For a bond that forecasts the future cash flows is in the contract. You're actually told up front what it's going to be. So it's pretty straightforward. So how do you know the cash flow on the bond? Well, it's its coupon. The coupon is that legal stated number in the contract that tells you what your income is going to be. You get that paid now. No, on the fact exam, they do this. Bonds don't pay interest once a year. They pay interest twice a year. On the fact exam, they have interest paid once a year. That bond doesn't exist. All right. So treasuries pay twice a year. Corporate bonds pay twice a year. The only bonds that don't pay twice a year are discount bonds, and they don't pay ever. They just, you buy for 99, and it matures at 100. So there is no coupon. So coupons pay twice a year. So you'll get this coupon, but half of it 2 times instead of getting the full amount once. What does the coupon apply to? It applies to the face value, the par value, the maturity value, the principal value. We have all these terms that mean the exact same thing. But that's the amount you can get paid back when it matures. So I've got this charity I'm helping. We had a bond mature today. Its maturity value was 20,000. So we got 20,000 bucks and we got 6 months of interest. So we got 20,000 bucks plus an extra 300 and something bucks. And the 20,000 is the face value. That amount might have been $20,016 3 weeks ago because the interest rates are rising and falling. But when it matures, the federal government, this is a treasury, the federal government will pay us exactly what we loaned them, the $20,000. So that's why it's the principal amount. It's what they borrowed. It's also the maturity value because they're going to pay you back what they borrowed. But the face, that's just what shows on the certificate that you borrowed, or the par value. Treasuries are non-amortizing, which means they only pay interest until the very end. Whereas your mortgage is what? Amortizing, right? You're paying principal and interest as you go. Have you ever heard of a negative amortizing bond where the interest they're paying is less than what they need to pay? So the principal is actually growing. That's like the worst possible bond ever. But so we're not doing amortizing bonds. Why? Because amortizing bonds are really complicated. Because what can happen on your mortgage? They can pay off early. Does that make the forecast a little more difficult? It makes it a whole lot more difficult. Mortgage-backed securities are very, very, very complicated bonds. Just to let you know, I learned this from the life actuaries. How do you figure out the market price of a mortgage-backed security when you don't know when you're going to get your cash? And when do you get your cash? At the worst possible time, right? You loaned it at 6%, but if interest rates fall up to 4%, they're going to give you cash back so you can reinvest at 4%, which you'd rather just keep paying 6%. The way life insurance actuaries and others price mortgage-backed securities, they run 269 scenarios of interest rates rising and falling all over the place. Sometimes rates fall, so people prepay. Sometimes rates rise. They do all these scenarios. They assume each one of those 269 scenarios have an equal chance of happening. They take the present value of the cash in each one of those 269. They take the sum of all of that. Each is 269ths. And the sum of all those scenarios is the price of the bond. We don't have to do that with treasuries. Why? Because the U.S. government has to pay us off on schedule. You have to pay us interest every 6 months. Can the U.S. government prepay its debt? So Trump in his first administration scared the bond markets because he said, we're just going to pay off all our debt at par. Can the U.S. government do that? you loan the US government 5%, and in 2020 interest rates were 0.5%, can they just pay it all off at par? That would be illegal. So he couldn't do that. He might have liked it. It would have been a great thing for government to do, right? They owe 6%, but they can just pay everybody off at par today and reborrow at 0.5%. That would have been a great thing to do, but it would have been illegal. So he's somewhat scared. The bond market actually adjusted, not much, because I think everybody knew there's no way he can do that. But that's the difference. Non-amortizing bonds, they pay off exactly as there's no prepayment. Now, can the government buy back its bonds at market value? Yeah, they can do that. And the federal government has been doing that, right? That's what Q2 is. QE1, QE2, that's what they're doing, buying back and selling bonds. So they can buy bonds that they have to buy them at the market value. Because non-amortizing bonds, they pay a coupon every 6 months and they pay principal at the end, and there's no refinancing, there's no paying off early. Now, corporate bonds can pay off early if they're callable bonds. Those are more complicated, but treasuries, you can't. I don't care what the president says, he cannot go out and refinance US debt at par. He just can't do it. He has to pay market values, right? So we're keeping it pretty simple. So our forecast is real simple. The only way we're wrong is if the US government defaults on its debt, which hopefully is unlikely to happen. Most people that can print their own money don't default on debt. You can run down to your basement and print money anytime you want to. You're probably going to pay off all your debts without too much trouble. So hopefully US government can pay off its debt. Would be really inflationary if they did that, but they could do that. Then what is the discount rate? Well, the discount rate, the market's going to tell you. So we're going to be using the market's current discount rate. The discount rate is the current risk-free rate plus the spread. If we do treasuries, there is no spread. The spread is for risk. There's no credit risk for treasuries, we're assuming. So how do we figure out the discount rate? Well, we look at the maturity of the bond. It's a 5-year bond. We're going to use a 5-year treasury plus a 5-year spread, right? It's pretty straightforward. You should have done that in 2013. So corporate bond spreads, you talked about this some on exam 1. Corporate bond spreads, they reflect the probability of default. If it's highly rated, it's going to be a really thin spread. If it's a low rated bond, it's going to be a really wide spread. All right, so pretty straightforward. I'll give you all of this on the exam. You just have to know how to interpret it. Then you discount the cash flows, which is really straightforward. You compare your value for the bond for what you can buy it in the market. Just like with stocks, you decide whether you're going to buy them or not. We're actually going to not figure out what we think the bond is worth. We're actually going to try to back into what the current market value of the bond is. All right, it was a little bit different. And then you make a buy or hold or sell or ignore a decision, whatever you want to do. I think treasuries look pretty good right now. I was looking again this morning for my charity since their treasury matured. I looked out, I have an account at Schwab. Treasuries are still, for the period I'm looking at, are still paying higher yields than CDs. A CD, a certificate of deposit, is essentially risk-free because if the bank goes under, you know, Silicon Valley Bank, if you had a CD, the federal government's going to bail them out. So it's essentially risk-free. But I don't like CDs. They're much less liquid. They have penalties. There's a lot of things I don't like about them. So a CD has to pay a much higher yield for me to go for a CD versus a treasury. One thing I hate about CDs, if you have to get your money early and you surrender it, they're going to charge you like a month of interest. It's really expensive. With treasuries, if I want my money back on a treasury, I just sell the treasury. And I might actually make an extra $3 or $4. Worst case, I'll lose a couple of bucks. So treasuries to me, if all else is equal, I'll go with the treasuries. Very liquid, very easy to sell. CDs, very liquid, have penalties. So I had bought a CD because they were paying an extra 20, 30 basis points. So like, okay, we're not going to sell it. We don't need the money. So we'll take the extra 30 basis points. But today, treasuries are slightly higher. It's like no brainer. I'm going to buy the treasuries. So those are the kind of decisions that you're making. Here's the terminology you need. We just talked about the face value, principal value, par value, maturity value, the coupon. The current yield is what the bond is yielding in the market today. It might have a coupon of 6%. The current rate might be 2%. So you got a really great bond. It's paying you 6%, and the best you can get anywhere else is 2%. That's going to be a great bond. It's going to trade at a premium. We'll talk about the current yield. We'll talk about the effective yield. You do need to know this equation. There are a lot of other yields out there that we're not going to learn. The bond equivalent yield, there's a few others. You don't need to know those. I hope they don't do the bond equivalent yield anymore. The reason we have these other yields is because we didn't have calculators and we didn't have computers. So what they did on some of the other yields is they just assumed a year was 360 days and a month was 30 days, because it makes the math a lot easier. But with Excel, you don't need that, do you? You can handle 365 and 31 without too much trouble. So bond equivalent yields, those kind of things are not important. So we're gonna stick with the current yield. The current yield is real similar to the IRR. It's essentially the discount rate that gives you the current price of the bond. All right. So if your coupon is greater than the yield, if it's greater, it's going to be a premium because you're getting paid 6% in a market that's paying only 2%. That's a really good bond. You're going to have to demand more. You're going to demand more than $1,000. If your coupon's less than the yield, then your bond's going to pay at a discount. Your bond's paying 3%, but the market's paying 5%. You're going to have to take a discount to get that bond. Now remember this formula, the percentage change in the bond can be approximated. We're actually going to use this to check our work. You'll see how we're going to do that. We're not going to use convexity, but convexity should be in there. So when we use this formula to estimate our answer, we should be off a little bit because there's probably some convexity there. So the best way to do bonds is to do bonds. Let's just do it. Let's see how much you remember from 3013. Y'all all passed the fact exam, right? Or you wouldn't be in here. So remember in the exam, they had a bond paying 1 coupon. So forget that. So we're not going to do that. So let's do a treasury. Let's say it's a 30-year treasury issued 10 or 20 years ago. So from a market standpoint, what kind of treasury is this? It's a 10-year treasury, right? All we care about is how much time is left. So our time is going to be 10 years. So what is the coupon on this bond? Let's get the treasury yield curve. Let's go find, I said 20 years ago, so 2005. The 30-year treasury, I'll take this rate, would have been, so when treasuries are issued, I'm not, well, there's the 30-year, but they don't have a 30-year, but what year was that? 2005? They should have a 35-year back there, but we'll just pretend it's the same. When the U.S. government issues a debt, it issues it at par. So the coupon and the yield are the same. All right, so 488. We'll just do 4.9% to make it a little bit simpler. And what is the yield? But a yield is what is that rate today? But we're not going to use the 30-year. What are we going to use? Use a 10-year, right? Because it's a 10-year bond now. And the current yield on a 10-year is 4.23. So is this bond going to trade at a premium or a discount? It's paying you 4.9. The best you can get anywhere else is 4.23. Be a premium, right? This is a pretty good bond. But bonds pay twice a year. So if we use 423 to discount this bond, we're ignoring the time value money or the kind of compounding interest. So we have to use an effective yield. What we do with the effective yield is we want to just say it pays every 6 months, but since it pays us in 6 months, we can take that 6 month and reinvest it. So essentially, we're going to assume that we can take that coupon, that 4.9, and reinvest it for 4.9. So essentially, what we're going to do is we're going to take 1 plus the yield divided by 2 raised to the second minus 1. That's how the effective yield works. That's because it pays twice a year. What if it were a CD? What would you do? You would take 1 plus the yield divided by 12 raised to the 12 minus 1. All right. So what you divide by and what you raise to is the same number. What you're trying to do is just get that compound. Y'all probably have heard this, right? Y'all familiar with the term APY, annual percentage yield? That's what the APY is. So the CD might say, hey, our stated yield for the CD might be 5.2%, but the APY is 1 plus 0.052 divided by 12, raised to the 12th minus 1. The APY is 533. What do you think the bank's going to advertise? The 5.2 or the 533? The 533. That's fine, but if you take your interest out of the CD, you don't reinvestment, you're only going to make 5.2. So the 5.3 assumes you leave it in there, and they're actually going to pay you interest on interest, which is kind of nice. But the APY is essentially your return if you leave the interest in the CD and you let it compound on itself. That's the APY. So we have to do the same thing with this bond. The effective yield will always be greater than the yield. It has to be because you're assuming that reinvesting. So here we'll take 1 plus the 423 divided by 2, raised to the second minus 1. Hopefully get a higher number. And we do. So 427, that's going to be our discount rate. All right, that's our KD, the effective yield. Now let's do value. So there's four approaches. You have to use one of them on an exam, but if you want to do all four of them, that would be fine. I'd be really impressed. I've had students do all four of them. The first one I hate is the Bill Gates approach. The second one is the duration estimate approach. It doesn't give you the answer, but it gives you an approximate answer, so you know if you're in the ballpark. No, I guess I'm only giving you, oh, then there's the formula approach. And then there's the table. The table is required for the exam. All right. The others you can do is testing, which means you can check your answer in your calculator if you like. I don't use calculators. I don't even use Excel. But let's try the Bill Gates approach first, and I can never remember how to do it because I don't do it this way. But the present value, what is our rate here? 0.0423 divided by 2. All right. So you remember when y'all probably did this on the fact exam, except for you didn't have to do. You see why they didn't give you 2 payments, because it gets confusing. But your rate is 423. That's your discount rate. But we're dividing by 2. Why? Because it pays twice a year. Comma, what's the next thing? Number of periods. How many periods do we have? 10 times 2. So 20 periods, right? It's a 10-year bond. It's going to pay every 2 months. What's our payment going to be? Our coupon's 4.9. So we're going to get $49 a year, but how much we can get every 6 months? What's 49 divided by 2? 44.5. Is that right? And then what's my future value? Going to pay $1,000. And then what else do you have to do? You have to do minus, right? Does that look correct? Might be. Could be correct. But you can do, can y'all do this on your calculator? So you can double check your answer if you do on the calculator. Use the PV function. I hate calculators. The last time I asked for I remember at USA asking Jason for a calculator in finance, and he took his HP out, blew all the dust off of it, and handed me his calculator. That's how often we use calculator. Why don't we use calculators at work? Because you have Excel. Why would you use a calculator at work if you have Excel? Right. We don't do this in Excel either because, well, I'll show you the formula approach. But anyway, that's the present value. It's the present value of $44.50, which you're going to have an ending value of 1,000. What is that worth today? If your discount rate's 423, but you're doing every 6 months, you got to divide by 2. You're doing 10 years, but every 6 months, you got to multiply by 2. So that's it. Let's try the duration approach. So the duration approach says the percentage change in the price should equal minus duration times the change in yield. All right, so here we have a problem. What is the duration of a 10-year bond? I'm going to make a guess. I don't know what it is, but I'm going to say 9.3 years. All right. It's going to be less than 10. Why? Because it's paying coupons every 6 months. That's going to shorten it. All right, so let's try this guess and just see. So we're going to take minus duration times the change in yield. What did yields do? They were 4.9. Now they're 4.23. Oops. Minus duration times, oh, I did it backwards. So interest rates are 4.23. They were 4.9, so they fell. So the bond price should be 6% higher. So Bill Gates looks wrong. What did we do wrong on Bill Gates? We'll see. So you take $1,000 times 1 plus 6%, get 1,062. Which of those is correct? Oh, I know what I did wrong. This is wrong, right? What is that number? All right. So see, Bill Gates is wrong if you enter the wrong number. All right, I get
22.
24. All right, so I'm just seeing if y'all are paying attention. All right, that's looking pretty close now, right? So duration says it's about 1062, but I don't know if my duration's correct. Bill Gates says 1054, but he's never right. All right, let's try the formula approach. So this one I never get right the first try. So hopefully that's right. Let's just try $1,000 times 0.049 divided by 2, 2450, 2450. All right. I can't do math when people are looking at me. All right, the formula approach is, remember when you took accounting, they had the present value interest factor annuity in the back of the book? That's essentially what this is. So let's think about this in stages. Don't write all this down. I've had a couple of students do this on the exam. I'm really impressed if you do it. I started doing this because I was thinking about it on my bike, and it's like, wow, that'd be a really simple way to do it, which is essentially what Bill Gates is doing. So we're getting 2450 every 6 months. What if we got 2450 every 6 months from now for all of eternity? A cash flow that you get for all of eternity is worth the cash flow divided by the discount rate. So the discount rate is 0.0423 divided by 2. So we'll see if I can get this right the first try. So if this thing was a coupon that paid forever, it would be worth $1,158.39. But we're not getting the coupon forever. So what are we doing? Well, in 10 years, we're going to get $1,000, but we're going to stop getting the 2450. So let's subtract out all those coupons after 10 years. So 2450 divided by 0.0423 divided by 2. So we're going to get $1,000, and then we're going to lose that 158. But that's in 10 years, right? So what do we do with this? We divide it by 1 plus 0.0423 divided by 2 raised to the 20th. We take the present value of that, and when we add those two together, does that look familiar? So is it possible Bill Gates and I are both wrong? When's the last time I was wrong at the same time Bill Gates was wrong? I bet you can't name it, right? So probably correct. So you see what we did here was essentially took the present value of infinity, then we added $1,000, subtracted the infinity, but 10 years out, discounted that, and that gave me the value. If you take this $1,000 out, that's essentially what that present value of interest factor is doing. It's saying, what if I get 2450 for eternity every 6 months, but then I subtract that time after the eternity, after my 10 years. So that would give you the factors. So that's another way you can test it. But that's not, I want that on exam either, but you can do that on exam to double check. My guess on the exam, if these two numbers are the same and you do this on the exam, you use your calculator, you can't use Excel, but you use a calculator, you use this formula, you get the same answer. You're probably pretty confident, but you have to do the table. Why do you have to do the table? Because I know students that plug things in calculators and have no clue what the calculator is doing. Your boss doesn't want clueless people. You got to know what your calculator is doing. You should know it very, very well. I once had a senior vice president whose pay was more than 10 times mine spend the entire morning trying to calculate standard deviation, and he couldn't get it right. He finally came to me. He was doing it in a calculator, And it took me 12 seconds in Excel, and I showed him that he was using the n-1 instead of the n standard deviation using the sample. And I was like, next time come to me, I'll take 12 seconds and you can pay me half of your excess salary for the morning, and I can save you money. You can go play golf somewhere. Why? Because he grew up pre-Excel. He's a really smart guy, but he's pre-Excel, so he didn't. You got to know what these formulas are doing. So what is the formula actually doing? So Emilio, you did this, right? In my class, if you remember it, you want to come show it, or you want me to try it the first time? Okay. So how many periods do we have? In 6 months, we get a cash flow. In a year, we get a cash flow all the way out for 10 years, right? We're going to get a cash flow every 6 months. What's our cash flow going to be? Well, it's going to be $24.50, right? $1,000, we always assume the face is 1,000 times the coupon, 4.9% divided by 2. And we're going to get that 19 times. What do we get the very, very last time? Yeah, we get our $1,000 back. How hard of a forecast was this? Are you confident in this forecast? Pretty confident, all right? A lot easier than doing a stock or doing a mortgage-backed security. All right, now we got to discount it. I was bad-mouthing Bill Gates and he's watching me. So we need a discount factor. So here what we're going to do is take 1 divided by 1 plus our effective yield. Raise the time. And that factor should be 0.99 something or 0.98 something or 0.97 something. All right. Just discounted cash flow. Now, you're probably thinking, why do we do the effective yield? So we could have taken 423 and divided by 2 and multiplied it by 1 for the first period. I mean, there's different ways to do it. I do it with the time as 6 months, and then I use the effective yields. So it kind of depends on which way you're taught. So you're going to do my approach here, but I'm going to lock in the rate. So your discount factor is going to get smaller and smaller and smaller. We usually go out 4 decimal places. You saw that in your accounting classes. 4 decimal places works really, really well. Oh, Sebastian was in that class too. Between the 2 of y'all, could y'all do this? You remember enough? Yeah, that's the last. Yeah, anybody else in that 3013 class? Y'all did this in 3013 though, right? All right, so why do we go out 4 decimal places? Because we're doing dollars and cents. So we only need 2 cents. So if you go out 4 decimal places, your rounding won't be a huge issue. You can have a little bit of a rounding issue on the exam. I'm not giving you a 10-year bond. I'm giving you a 2-year bond, so you'll have plenty of time, but you'll be doing this. And so, yeah, Emilio's right. The next thing we do is the discounted cash flow. There we just multiply across. Our cash flow times our factor times our factor. So how much is $24.50 worth? If we get it in 6 months, if our discount rate is 423, it's going to be worth 24 bucks. That goes all the way down. And so what is our price in this case? We just sum all that up. Yeah, and I got a problem there. I don't know why I have a problem there. Did I use 427?
I think you use it for
Yeah, you should use 427. So I'm testing to see if you are paying attention. Does that look close? If you got that, and that on an exam, would you be pretty confident? You only have to do one of them. You have to do the table, and we'll practice this over and over again so you'll get better at it. What's the last thing you could do? I've had some students do, the ones that really want to show off. What's the duration of this bond? What is duration? The weighted average time to maturity using discounted cash flows as the weight. That's all it is. Here's time. Here's the discounted cash flow. So we just take time times the cash flow divided by the price. Multiply that down. So the actual duration, I guessed, I don't know where it is. 9.3, where did I put it? It's somewhere up here. But I guess 9.3, did I delete it? Oh, way over here. The actual duration. Oh, 8.01. Wow. Luke Younger was correct today. So that gives me 154.17. How close is that? That's pretty close. How confident would you be? This one can be off, but how confident would you be if you got those 4 answers on the exam? What's the chances you get? Because those are 4 very different approaches, aren't they? So the probability of some math error in there somewhere would be pretty, unless you type 4.8 when it's supposed to be 4.9 and just mess it up. I usually don't count off for that if I catch it. All right. So that's what a bond is. It's just the present value of these cash flows. It's very easy to forecast. You're just discounting cash flows, 1 divided by the rate raised at the time. You do that a bunch of times in finance. Pretty straightforward. You don't have to calculate duration on the exam, but you can if you want to. The advantage you have on exam is a 2-year bond, and 2-year bond durations are going to be 1.9, 1.95. So it's going to get you much, much closer than a 10-year bond. But you have 3 ways to do it. I did Excel, but anybody able to do this on your calculator? Anybody try it? No, you try it. So you should have a PV function, all right? And then it should tell you. Calculators, to me, I don't like them because I feel like I got to keep entering calculate. It's like it's obvious that, it's not like Excel where you just enter it. All right, let's try it again. So this time, let's try a 15-year Treasury issued 10 years ago. All right, so what's our time here? What kind of bond is this? It was issued 10 years ago, but it's 15 years when it was issued. So 5-year bond, how much time is left? Now, on the exam it's going to be 2 years. It might be a 10-year bond issued 8 years ago, or a 20-year bond issued 18 years ago, or something. It's going to be 2. You just could put a calculation. All right, let's look at the coupons. So here we're going to look for a 15-year bond issued 10 years ago. So 10 years ago would have been 15. It's a 15-year. There's no 15, but we'll kind of go in between. 231. Let's say 220. Boy, interest rates were really low back then, weren't they? What's the yield today? So it's a 5-year bond today, and its yield today is 396. So is this bond this bond's paying you 220, we can get 396. Is this a premium or a discount bond? It's a discount bond, right? Looks pretty bad. Do the effective yield. We take 1 plus the yield divided by 2 raised to the second minus 1. It has to be higher than the yield. Right, so let's try it. So Bill Gates, see if I can get this right. Well, let's get our cash flow first. So I don't get, so our coupon's 2.2. So $1,000 times 0.022 divided by 2. So $11. So from Bill Gates' standpoint, we do minus PV. The rate here is 0.0396 divided by 2. Number of periods is what here? 10, because it's a 5-year bond, so every 6 months. Our payment's $11, and our future value is always going to be $1,000. We're expecting a discount bond, so it should be $900 and something. So sure, if you're up 920, let's see if Bill Gates got it right. Let's do the guess approach. So I'm going to guess on duration. Oh boy, I'm getting really bad at this. Let's say 4.3 years. So in that case, we get minus 4.3 times the change in yield. So yields today or 3.96. You don't use the effective yield here, you use actual yield minus the coupon. So rates have actually risen. So we expect this bond to have fallen 7% in price. So we take $1,000 times 1 times that. We get 924, kind of in the ballpark of Bill Gates, but not quite, but kind of there. And then we'll do the formula. So we'll take $11 divided by 0.0396 divided by 2. So that coupon, if we got it for all of infinity, would be worth 556 bucks. But that's not what we're going to get. We're also going to get $1,000, but we're going to lose the $11 divided by 0.0396 divided by 2. We're going to lose that. So when we take that, the $1,000 minus the infinity, and divide that by 1 plus 0.0396 divided by 2 raised to the 10. You get that. When we add those two together, you get 920.87. Does that sound right? Looking pretty good. You're getting pretty confident on the exam. Why do I like this formula so much? Just theoretically, that's what a bond is, and that's what discount counting is. You got infinite cash flows, and then you subtract out the non-infinite cash flows. It really is what that present value interest factor or annuity is, exactly what it's doing. So you're essentially backing into that formula. And then we'll try the table approach. So we got time, cash flow, discount factor, discounted cash flow. So here we got cash flows every 6 months, out 5 years. We're going to get $1,000 times 0.022 divided by 2. So we're going to get $11 at the end. Get our $1,000 back. Discount factor is 1 divided by 1 plus our effective yield. If I can get that one right this time. Raise the time. Should be about 0.9 something. Should be way, way off. Copy that down. And our discounted cash flows. That gives us a value. That looked right. Pretty good confidence there, right? You're getting the same number 3 times. Anybody got on their calculator yet? Nobody? I can't be better at this than y'all are. Y'all should be like speeding past me here. Anybody trying it in Excel? Does it work in Excel? I don't know why you wouldn't get it in Excel, but maybe Bill Gates isn't working on your machine. All right, if we do duration, just as a double check, so we can do time times the cash flow divided by the total, because we're doing a weighted average. It gives us a duration of 4 points. Wow, I was way off on that one. So my duration estimate would have been $9.16. It makes sense that it's lower, right? There's your positive convexity. It's surprising on that previous one, it came in so close. So you would think this one would be lower, but you don't know what the duration is, but here's 4.74. So if you think about duration, this is where I didn't think through this enough, but duration is the weighted average time to maturity, but you know that last cash flow is going to dominate it because it's the biggest. Here, I should have known the coupon was so small, that 2.2%, that's really going to have an impact. It's going to increase your duration. Why? Because you have much less cash flow in early years because of low coupons. So you have much more in that last year. So when coupons are low, duration is going to be much higher. And I should have figured that out and used the higher duration. On this one, the cash flows are much larger. So I should have come up with a lower duration because they're going to have more weight because they're larger. So when your coupon's large, duration is going to be smaller because you're pulling time closer to the current. When coupons are small, your duration is going to be much, much higher. Now, Here's what Wikipedia says, and that's what I just did. Isn't it? Jargon does this formula. We're taking the present value of those cash flows from I1 through N. We're doing it on the top side. What's the only difference in the numerator and denominator? It's time. That's exactly what we just did. Right? That's Macaulay duration. Poor Macaulay made a math error. They should have just fixed the math error and call it Macaulay duration, but they didn't. They fixed the math error and called it modified duration. So they fixed this error. So all you have to do is essentially divide by 1 plus the yield. So the actual modified duration is slightly lower than the Macaulay duration. So he had one slight little error in there, but that's modified duration. There's also others, Fisher-Weil duration, key rate duration. There's also spread duration. Spread duration was created after I retired, so I've never used spread duration, but I did ask the guys at Victory Capital and ladies and men at Victory Capital, and they do use spread duration. I don't see the point of it. It doesn't make sense to me as a useful tool, but they said it is. But essentially what spread duration says is not how much does the bond price change if interest rates change, but how much does the bond price change if the spread change. So it's just a different calculation. But those are all the different. So really on this duration, I should have divided, it should be a little bit lower than that. I should divide it by 1 plus the yield. It gets a little tricky on exactly how to get the modified duration, but that's what duration is. So be real careful. When I say you should know duration, I mean it in two senses. First, its formula. And there's this formula right there, the weighted average time to maturity. You just take each time period times this discounted cash flow divided by the total cash flows. The sum of all that is your duration, right? You can do modified duration in just a little bit, but it's essentially it. And then its use. Its use is what? Minus duration times the change in yields. You should know both of those. So if someone says, do you know the formula for duration? Well, the formula for duration, this is not the formula for duration. Here you already have duration, you're plugging it into a formula. That's the formula for how sensitive a bond price is to changes in interest rates, right? The actual formula for duration is this right here, or if you want to use Wikipedia, if I can find it, it's this right here. Pretty simple formula because you're just valuing a bond, but then you're taking those discounted cash flows. Now, can you do modified duration in your HP calculator or in Excel in a formula? I don't think it's possible. I don't think there's an equal duration formula in Excel. Is there one? Equal duration? It's there. Well, let's see. I probably lied. Maybe Bill Gates, he's so mad at me. Settlement, I don't know what that means. I'll say $1,000. Maturity, I guess that means 5 years. Coupon, maybe it's 10 periods. Coupon is $11. The yield is 0.0353. I don't know. Frequency. Oh, semi-annual. All right, Bill Gates is not as bad as I thought he was. Maybe there's something there. And it gives me a bad. So I don't know what you're supposed to plug in there. This is the first time in my life I've ever seen this. So it's supposedly there. Someone figured that out for us and give us a modified duration. That would be pretty cool. I'll have to look it up in on Google. But so there is a formula, but he even has a modified duration formula. But why do I prefer this? Because if your mind can see what the calculations are, you know what the formula is. Too many finance majors, formulas are things you plug into Excel and you plug into calculators, but you don't know what they're doing. I've seen that with standard deviation and beta and duration here. Bond valuations, you should know what the formula is actually doing. So you know how sensitive it is. What if you change this? What if you change this? You're not going to get that. That's one reason, they ask on the CFA exam, If interest rate rise, what happens to durations? Well, if I see the whole formula, I can go through the math and figure out what happens to it. All right, and you can kind of figure that out, right? If interest rates rise, what happens? Well, that final cash flows can get much, much, much smaller, right? A 10-year cash flow is much more sensitive than the current one. So if interest rates rise, that's going to make the earlier cash flows have much more weight. And so that's going to reduce your duration because you're giving more weight to 0.5 than your own year 10 or period 10. But you can do that in your mind if you think about it. If all you know is equal mod duration and gives you a number, you're not going to know how it changes. If the coupon is higher or lower, those are the kind of things that you'd want to know. And that's a wonderful thing with duration. If interest rates rise, duration comes down, which means your bond becomes less sensitive to interest rates and interest rates rise. What is that? That's positive convexity. Duration falls and interest rates rise, and that's why you get positive convexity. So all this stuff fits together. If duration didn't change, then you wouldn't have positive convexity. It'd just be a straight line. But duration falls, which means you get less sensitive to interest rates as rates rise, which is exactly what you want. What happens when rates fall? When rates fall, this cash flow becomes much bigger weight. So your duration is going to go closer to the maturity, which means durations rise if interest rates fall, as interest rates fall, which is exactly what you want. You want to become more sensitive to interest rates as they fall, so your bond price rises more. So y'all see how just knowing the duration formula, you can see convexity in practice. It's actually all there in the formula. All right. Do we need another treasury? We'll price one. On the exam, we don't do a treasury. On the exam, we do a corporate. So how do we look at a corporate? So with a corporate, yeah, I'm making sure I'm still in Zoom. I'll give you a table like this. I'll try to update it to current numbers, but it's really tough for me to get all these numbers. But with the corporate, you need a risk-free rate and you need a spread. These are the spreads. You have a spread for each credit rating, and you have a spread for each maturity. The maturity is going to be the same thing as we just did. So if it's a 15-year bond issued 10 years ago, it's a 5-year bond. So the time depends on how many more years until this bond matures, right? And then the credit quality is whatever I give you on a credit quality, but I'll probably give you two credit qualities. I'll give you the credit quality when it was issued and the credit rating today. Which do you think you care about? The one today, right? You don't care about what it was rated. It might have been double B when it was issued or triple B when it was issued 10 years ago. Now it's single A. It's a single A bond. All right. What do you notice about these spreads? First of all, as you go down in quality, what happens to the spread? They increase. That makes sense. What else happens? What happens as you go across time? They increase. Anybody know what that's called? So this is the term structure of interest rates. Treasury yield curve, term structure of interest rates. Normally, it's upward sloping. If I can find, oh, that's right for the 2008. Normally, it's upward sloping, right? That's the term structure. And y'all studied in, well, I was supposed to do it in 3013, but you ran out of time. But hopefully, in your money and banking class, you studied interest rate theory and why does the yield curve shape like that? You have the interest rate theory, you have the inflation period, you have expectations theory. But that's the term structure of interest rates. We use the treasury yield curve. We expect higher rate, the longer term rates to be higher. This is not the terms when spreads rise as you go out in time, or like triple B bonds go from 82 to 177. That's not the term structure of interest rates. That is the term structure credit spreads. So term structure of interest rates is how do treasury rates differ different maturities? And you usually have 11 points on the yield curve. That's the term structure of interest rates. You have three theories, or at least I was taught three theories on why the yield curve has the shape that it has. This is the term structure of credit spreads. And we know with interest rates, sometimes longer term rates can be lower than shorter term rates, especially if we're expecting a recession. The term structure of credit spreads is almost always upward sloping. 10-year bonds always have higher spreads than 5-year bonds, right? So that's always going to be upward strokes. So if I give you a 15-year bond issued 10 years ago, you're going to look in the 5-year category. If it was double A when it was rated, but now it's triple B, you're going to look at the triple B. So you're looking at for the spread for the year that are left in the current credit rating. And then you have this 104. What in the world is that 104? Basis points. So what is that in a percent? 1.04%. All right. How do you convert it? You take 104 divided by 10,000. Okay. So that's exactly what we're going to do here. We're going to price a bond. We'll get started. I don't know if we'll be able to finish it. Once you get this, the coupon and the yield and all of that, it works exactly like the Treasury. So let's say this is a 15-year corporate issued 10 years ago, rated single A at issuance, and is rated will be today. All right, so what is the term here? 5 years. What's the rating? Triple B. So let's find out the coupon. So the coupon, I'm going to go back 15-year bond 10 years ago. That's the same thing we just did, isn't it? Kind of. So 475. So at issuance, the risk-free rate is 4.75%. And let's say at issuance, the spread was, see, I can't find the spreads back then. I could find it, but I don't have that spreadsheet open. 2010. So you're coming out of the dot-com crisis. Let me look real quick. I can actually show y'all. March. So you can get from Bloomberg, you can actually get bond spreads. We're talking about a single A rated bond. Talking back in March of 2010. Or yeah, 2000. No, it's issued 10 years ago. That's where I'm messing up. Let me get that right. So 10 years ago would have been 2015, right? So about 107 basis points for that. Still pretty high. I don't know if I did that right. So a 10-year bond, 15-year bond issued 10 years ago. Did I get that right? 10 years ago, been 2015. So around, oh, really low. So let's say 240. So the coupon would likely be 240 plus 107 divided by 10,000. Now I give you the coupon. You don't have to calculate this, but I'm just trying to figure out a coupon that's in the ballpark. Let's just say 350. So issue the coupon at 350. A pretty decent spread, but the risk-free rate was really, really low then. That 107 is a pretty high spread for a single rate bond. You can see here, well, not that far, 15 years, I guess that wouldn't be that far off. All right. So now it's a triple B bond. So that's the coupon. So let's figure out the discount rate. The discount rate is going to be a risk-free rate. You do have to do this part on the exam. Plus a spread. So which risk-free, if I give you interest rates along the entire curve, what did y'all say this bond was? 5 years, right? So there's your risk-free rate, 398. Let's just say 4%. And then what's our spread going to be? 5 years, 104, right? 104 there. So what is my current yield? 4% plus 104. 5.04%. Is this a premium bond or a discount bond? Pays 3.5. In the market, you can get 504. It's going to be a discount bond. Get your effective yield. Same way before. 1 plus 504 divided by 2, raise it to second minus 1, 510. And then we do everything we did over here the same way. So you have the 3 approaches. Let's get Bill Gates out of the way and then I'll let you go. So equal minus PV. Our rate is 0.0504 divided by 2. Number of periods is what? 10. Yeah. What's our payment? So 35 divided by 2. Y'all know I can't do that in my head. Is that 1750? Does that sound right? And then what's my future value? $1,000. We know it's going to be a discount bond, so we're expecting like 960 or something. I don't know, 930. So 930. So we'll do the other approaches and see if we get the same answer in the other approaches, but that's how you do it. You know, on the exam, it's going to be a corporate bond and I can give you a treasury, but that's just having to deal with which risk-free rate to do and which spread. Once you get that, once you get this number, it's exactly like the treasury. So it's really, really straightforward. All right. I'll stop it there. You've got the data. I did not add a Nike in there. There's several others. There's amazing numbers of firms that are beating on earnings and their stock are falling quite a bit. But you got plenty of companies here to look through. I've got you all the data, although it'd be really smart if you would figure out how I got this data and learn how to use the Bloomberg machines, but I did all that for you. To give you some example papers from last semester, here's one on Alphabet. They did, I like this approach in the abstract, just saying what does a firm do high level, and then what you're going to do in this report. You talk about earnings per share. So you want to try to get it in one sentence. They reported $1.55, which was a 712 beat versus the expected, and 43% versus reported the same quarter last year. See if you can get that in one sentence. You use the word beat when you're talking about actual versus expected. You use the word increase when you're talking about last year. I've heard students say they beat last year by 46%. That's not the right term. I mean, it's probably okay outside of finance, but you don't beat last year. You're higher than last year. You're lower than last year. You beat. What if you're below? You would say miss. So if you're talking about the actual versus the expected, that's beat or miss. All right. If you're talking about last year, it's an increase or decrease. Okay. So just you want to use the nomenclature of the industry. So earnings pretty straightforward. You get full credit if you do that. Try to get it all in one sentence. If the $1.55 is different than the reported number, then you'll have to have a little bit of explanation on that. So you might say they reported $1.42 earnings per share, parentheses, $1.55 after adjusting for, and then you ignore the $1.42 and just focus on the $1.55. So this is the number in the comp column. This is the column, that's why it's in orange. You can see for Akamai, there's a huge difference between the reported and the comparable. And there's always been a big difference. So you hope you can find an article that will explain what that big difference is. If you can't find it, then just focus on the $1.66 and don't worry about the $1.95. Same thing on the prior year. The $1.66 is not compared to the 108, it's compared to the $1.69. Maybe they have some goodwill amortization or something they're doing that the market just doesn't think is all that important, and so they just ignore it. All right. So I've given you numbers. There's the beat, and there's the decrease. So they beat by 9.28%. That's $1.66 versus $1.52. They were 1.78% lower than last year. So I have all the numbers you need there. Then do the exact same thing on revenue. Alphabet reported 77 billion in revenue. Here he did this really, really well. 64 billion after adjusting for 12 billion for TAC. Now he didn't say what TAC was. it'd probably be smart to do that. Probably your boss maybe knows what that is, but which was a slight beat over their estimate. And usually revenues is a small beat. You don't usually beat revenues by 10, 20%. We saw a stock today that beat earnings by 500%, and they beat revenues by 1%. Earnings can be all over the place, but revenues are usually pretty close. So their revenues have increased 11%. So you beat over the estimate and you increase over the prior same quarter last year. You probably need to be clear. Here he is reported the same quarter last year. I'd probably use that terminology. You're not talking about the increase from last quarter. You're talking about 5 quarters ago or 4 quarters ago. So you're doing the same quarter last year. He did that here, didn't repeat it here. Then you talk about margins, and I give you margins in basis points. Well, the margins are in percents, but the change, the beats are in basis points. So they reported 59.37. This is Akamai. They reported 59.37. The market was expecting 72, so they missed by whopping 1,200 basis points. So here they reported a margin of 50. You don't have to go out that many decimal places, but they did have an adjustment here, which is a good 1,000 basis points greater than the estimate of 57%. The reported margins increased 160 basis points. So you get that in there. You can do it on gross margin. You do it on gross margin and for EBITDA margin. They missed their estimate by 990 basis points. And finally, we compared the same quarter, they performed better by 297 basis points. So you talk about the net and gross margins. So you get all that in there. Those are the easy points. All this stuff in orange is what you need to talk about. With the possible exception of EBIT, you could ignore EBIT and just talk EBIT margin. You've already talked about revenues. So EBIT margins is just EBIT divided by revenues. So it's kind of double. You're kind of doubling up, but talking about EBIT as well. You can talk about EBIT, but the main focus is make sure you talk about earnings per share, revenue, gross margin, and then EBIT margin is your net margin. So you talk about those. Then the next part of the paper. So there's 3 sections of the paper. You report the numbers versus expected versus prior year. Then you talk about why did those numbers come out like they did, and then you talk about how the market reacted. So there's 3 sections. So the second section is why did we get these numbers like this? So you're talking about what are those. So the key here for an investor is what are those key strategies? What is this firm doing to improve, to get better, to get more competitive? How are they addressing, or if there's some issue that's going on with the firm? So you're essentially explaining what's going on. That's why I say it could be good to listen to the conference call, the earnings conference call, because that's going to give you the idea of what really is important here. What are those sell side analysts asking? Those are the questions that are probably should be part of your paper. Alphabet's all over the place. They're doing all kinds of things. So you have to address some of those. So he had a couple of paragraphs, probably needs more than that, but he had a couple of paragraphs. He has a good quote. That's always good to get in there. And then how do the markets react? He used the charts that I built. So Alphabet stock opened. You don't have to do all that. You just really need to say how the change was. He put this entire chart in here. I didn't mean for you to put this chart in, but you can talk to numbers. So Alphabet was down 9.51% when the market was down 1.4%. It's industry, which is not a really good industry because it's communications. It includes telecoms. Even it's got the old tels in there. But it was down probably because Google, Alphabet's the largest one there, or second largest one there between them and Meta. Microsoft was actually up, so I put Microsoft in there, but who knows whom to compare. But you want to talk about how the stock did on that day. You have to do that. You need to compare it to the market. And then there's other things you can do. So you can see here, they added a chart for year to date. That could be perfectly good to do. He did that from Bloomberg. That would be fine. If you want to give them year to date, works pretty well right now because we're in the month, into the month of February, March, and you've had a good sell-off in some of the market. So that makes some sense. So the numbers, a discussion of what's going on with the firm, how the market reacted. You can add other things on the market, but make sure you talk specifically about that day. And that's the chart I gave you. And then some kind of conclusion, and their conclusion was kind of my recommendation, have a question to start that section, what to focus on moving forward, what does this all mean, those kind of things. So place that looks a little skimpy is not a lot of discussion here, but it doesn't necessarily have to be pages and pages, but a couple paragraphs is maybe a little bit light. Here's another example. This one's on a Nike. So again, an abstract that describes who Nike is and then what they're going to do in the paper. And then they reported 94 cents compared to 75, 26% beat. But the same quarter last year being 93, saw a slight 1% increase. Put a quote in there. I still think quotes, you should center them, but now this one, they decided to explain that earnings per share right when they talked about it. You can do that. It can start getting real redundant because whatever impacts revenues is always also going to impact earnings. And so you're going to find yourself saying the same thing over and again, but you can't. Then talks about revenue. It missed, but it was increased from last year. I don't know what happened here, but then they explain the numbers again. I don't like this approach because I think it gets tough with redundancy. I think you're better off tell the numbers and then say why the numbers did what they did, versus saying here's earnings per share. This is why earnings per share did this. Here's revenue. Here's why revenues did this. There's gross margin. Here's why it did that. It's just gonna get really redundant. But he put a pretty lengthy discussion after each one. Margin growth, again, beat by 50 basis points. And again, explaining it. So it's probably some repetition in that. They put a section in on projections for Nike. Pretty lengthy discussion. It is important with Nike, who's wearing their shoes. That can be important, especially right now with Nike struggling so much, trying to get back. Someone was asking me during the dashboard team today, Nike, the impact of Nike of changing the relationship with Foot Locker. Yeah, that's a big deal. Foot Locker is mainly in malls where no one's going to malls anymore, but it's still a pretty important distributor from Nike. If they're changing that relationship, what is that going to do? So you can certainly talk that. So maybe the first paper was too little. This one might be a little overkill, but definitely a long discussion. And then how did the market react? Talk about that particular day. They put the chart here. I don't like this chart in there. I think you can just talk the numbers. And here he's got 1 year that he can put in there. He didn't use Bloomberg to do that. And then they did a lot to look out for, but you can have some kind of concluding section, not much written here at the end. Show you one more. This one has a cool title. So Tesla earnings report, description of the company. This report is 66 cents, 10% miss. This one's a little bit strange. I don't usually say a minus 10% miss. I usually say a 10% miss. Because what does it mean they miss by negative 10%? It's kind of confusing. So I would say a 37% decrease, a 10% miss. I wouldn't say a negative 30% decrease. And definitely wouldn't say a negative 30% increase. I would just say decrease 37%, miss by 10%. It's pretty obvious they missed by 10%. It's a negative number. So that's a little strange way to word it. Same thing on revenue. This is not correct. Don't say marginal growth. You can just say margins. marginal growth. Marginal is not the same as margins. So don't say marginal growth. It's just margins. So does the margins. Then talks about, here they talked about why these things were driven, put some comments as they go, and then they talk about what's going next, what's coming up. Obviously, this is pre-election before we knew Musk was going to be involved in all the Doge stuff. Then talked about the stock market reaction. How do competitors do? That's not a bad way to do it. Just put them all on a chart versus showing. You notice they didn't put that chart in there. They created their own chart. Another good quote. This one doesn't have a final get off the chart, get off the stage kind of quote, but it doesn't have to be a certain format, but you definitely have to have a discussion of the numbers, a discussion of what's behind the numbers, maybe something about what's coming up next. Do the stock on that day. Make sure you do the stock on that day. I still have students that talk about the stock, what it's been doing the last 3 weeks or the last month, even numbers way after they reported. You're writing this paper as if you're writing it on the day the numbers came out. You don't know what happened since. So stop it on that day. All right, any questions on paper 2? You can get, have y'all picked your companies yet? You know what you're going to do. So you should be able to find, Bloomberg is great. You can find all kinds of articles on Bloomberg. In fact, well, in the dashboard team meeting, we showed students how to do that. If you use the GP function, so if you go into Bloomberg, let's say you're doing Tesla, you do TSLA, then you do equity, and you do GP. Tesla, you say equity because you're looking at the stock, not at the bond. GP is graph price. When you get into GP, you do, oh, I can't remember the words, but it's key news or something. You click on that. You can also update to show, well, you don't really do that because I've already done that for you. But key news, I mean, you can add earnings. If you do key news and earnings, there'll be a box in blue with an H, which is headline. And there'll be the earnings in red or green, depending on whether they missed or beat. And usually the headline and the earnings will be right next to each other. If you click on the H, you'll get a great article on their earnings report, which is probably going to be your best article of all because it's going to be a Bloomberg article. So if you use Bloomberg, the GP function is a really good function to do. There is also BI, which is Bloomberg Intelligence. If you go into Bloomberg Intelligence for your company, any articles or research or analysis they have on the firm is going to be in that list, and you should be able to find all kinds of stuff there. But there's plenty of places that you can go. The events will give you a link to the earnings call. So EVTS is not a bad approach to finding your earnings call. They have a transcript of it, or they even have a recording of it that you can use. So there's plenty of resources out there. So, all right, I'm going to leave paper 2. If you have questions, call me, come by office hours. Should be a fairly straightforward paper. Some students struggle on it. If your boss says, give me an earnings announcement update, you should be able to just dive into it without needing a lot of guidance. I think some students still need way too much guidance. So you got to get to the point where you can, it's just obvious what you should do. Or if you're not obvious, make it up on your own, talk to people, figure out what makes sense that your boss would need to know. All right, let's finish up the bonds. So last class, I was telling you, I like using the table because you can't get duration otherwise. And then I jokingly said you can't do equal duration, and then found you can do equal duration. I did figure out this formula. So what the formula says is the first thing is essentially today's date, or the date that you're buying the bond. The second one is the maturity date. So they actually need dates. The next one is the coupon. The next one is the yield. And you don't do it You do it annually. So if the coupon is 2.2, you do 2.2. You don't divide by 2. If the yield is 3.96, you enter that. And this last one tells you whether it's semi-annual or annual or whatever. And look what number they got. Does that look familiar? That's the same duration I got. So they have a duration function. If you do M, that's modified duration. It's going to be a little bit lower. You take Macaulay duration and divide by 1 plus the yield, you get a slightly lower number. But so I tried equal convexity. It doesn't work. So they don't have that built yet. But hopefully one of these days they'll do equal convexity and that will give you a number. Convexity is a little tougher for sure. But anyway, it's there. We have it. So and actually modified is the better number. So we'll use modified. And if with the modified, you get 918 versus 920. And there's where you see the convexity, right? With duration alone, you get a lower number than you get if you use the actual price. So let's try the duration function on this. Let's say settlement is 4/2/2025 and maturity plus it's 5 years, right? So let's try duration. Equal M duration. So the settlement is today. The maturity is in 5 years. The coupon is 3.5. And the yield is 504. And the frequency is semi-annually. There's my modified duration. 4.5 years for a 5-year bond. And remember what we said, if as yield changes, so the yield increases, higher yields, because you have that $1,000 maturing at year 5, it's going to be the most sensitive interest rates. And it's got the biggest weight. So you're taking that times 5. So if you increase your yield, you're going to reduce that weight. So it should reduce your duration. So as we went to a higher yield from 4% to say up 300 basis points, your duration is going to fall. Same thing with the coupon. If the coupon's higher, you're putting more of the weight earlier. So that's also going to reduce your duration. So the CFA exam asks that question. If you can get, so you can just visualize it and just think about it, it just solves you a lot of problems. It just becomes kind of second nature. All right, so we did the Bill Gates approach. This is a bond that is yielding 5%, where the coupon's only 350, so it's a discount bond. We tried the estimate. The estimate's going to say take minus duration times the change in yield. Maybe what I can do on the exam is actually give you modified duration, but not be required to use it on the exam. So you at least have it if you want to try it. So we do equal minus duration times the change in yield. What did yields do? Today, they're 504. They were 350. So the bond price fell 6.9%. So you take $1,000 times 1 plus that. That gives you 930.69. Pretty close, right? Gives you a pretty good estimate. Some positive convexity, but still a pretty good estimate. And we tried the formula. So we can get $1,000 times 3.5 divided by 2 for infinity. That's our coupon divided by our yield. And that gives us $694.44. That's what that coupon is worth. We probably should just put the coupon in here so we have it in dollars. So 350 times 1,000 divided by 2 because it pays twice a year. So 1750. So if you take 1750 and divide it by the yield, you have to divide the yield by 2. That's what you'd be worth. That's what you would pay for $17.50 every 6 months for all of eternity. It's not an infinite number. Why? Because as you discount out 20 years, 30 years, 4 years, you're approaching zero because the discount rate just overtakes. So eventually it converges on number 694.44. But you're not going to get that forever and ever and ever. What you're going to get is you're going to get $1,000, but then you're going to lose that infinity. But that's 10 years out. So 1 plus the yield divided by 2 raised to its 5 years, so 10 periods. To add those two together, and you get 932.68. None of these are required on the exam, so the only one required on the exam is the table. But those are the ones that give you check figures, and you get pretty confident. You get these 3 check figures that you're probably doing something right. So what you have to do is the table. Anybody remember the 4 columns? Fine. That's where. CF. All right, so it's a 5-year bond, so we're going to get cash in 6 months and a year, all the way out to 5 years. Now cash flow is $17.50, except for the maturity value. The discount factor, just like you did in 3013, 1 plus the rate raised at the time. So 1 divided by 1 plus rate divided by time. Go out 4 decimal places. And then your discounted cash flow, you just multiply those 2 numbers together. So your table value, 932.68. And they should give you exactly the same number, all 3 approaches. If I were you, and you have to do the table approach, I want you to visually see how a bond is priced. I won't be giving you a 5-year bond. I've only been giving you a 2-year bond, so you only have to have four rows. If I were you, I would do the Bill Gates approach because you got a calculator. You can do that real fast to double check your answer. That'll give you some confidence. You might get a slightly different answer because of rounding, right? Because I'm not rounding here. I'm going out. I'm not telling Excel to round the numbers, but if you round the effective yield, I'm using 510, but it's actually, I'm using this number going out that many places. So if you're using 4 decimals on the discount rate, you can get a number that could be off 2, 3, 4 cents pretty easily, depending on how the rounding kind of accumulates. And then we can ask, how good is duration here? You can do all kinds of tests. I wish they had a convexity formula in here. That'd be pretty cool. See how close we could get. Convexity would add a little bit to the price. I don't know if it would get duration and convexity are both approximations, and I can get you exactly the right number because not only is duration changing, but convexity is changing. Everything's changing as rates change. So you're not going to get a precise number, but you probably get within a few pennies if we had the convexity number in there. All right, let's do one more just to keep practicing. So there's corporate. And then we'll do one like it looks like on the exam, because on the exam you don't have Excel. Any questions on that? You feel comfortable with that? Y'all did this in 3013, but maybe a little differently, except for Emilio and Sebastian. They did it just like this in my class because that's the way I like to do it. I've noticed on the fact exam that students can't answer questions on the fact exam unless the fact exam asks it exactly the way they did it in their class. And that's not good. We're doing something wrong. So it shouldn't matter if I show you one approach and someone else shows you another approach. We're all doing the same thing. We're just tackling it differently. So don't learn bond valuation in one set way to do it. You should be able to be flexible and do it. So you can see how many ways did I do it here? 4 different ways. Did your class do it any one of these ways? Your class probably did it like this, right? Your calculator, is that how y'all learned it? Did you know what your calculator was doing? Did you know your calculator was doing all of this? I prefer this because I think as a finance major, you've got to understand the guts of what the calculations are. So you understand how duration and convexity work, but you can certainly use this. It's kind of a cheap way of getting the answer real fast. But you don't know all the calculations. So bottom line, it's just a discounted cash flow. And you should be the absolute pro of discounted cash flows in any form or fashion. It should be really simple. Huh? Well, I wish I could use Excel, but I don't know how to use Excel in a classroom. Yeah. In Emilio's class, they got to use Excel, but that was with me watching them, right? You ought to come up 2 at a time, and it's a pain. I've tried using Excel and I've had students just abuse the system, so it's tough. I wish we had classrooms with Excel without access to the internet that we could do Excel. You should learn it on Excel. Because the next time, after you graduate, the next time you use a calculator will probably be when you're 87 years old, showing your grandkids that we used to use calculators. You know, that's probably the next time you're going to use one. You're not going to use calculators. Why would you? You got Excel. Even now, you've got Excel sitting in your car on your laptop. You don't even need your calculator when you're away from the work. All right, let's do corporate 2, and then we'll show one from the exam. All right, let's do a 30-year corporate issued 10 years ago, rated single A issuance, and now is triple B minus. All right, so what's the term here? $20 years, right? It's 30-year bond, but it's issued 10 years ago, so there's only 20 years left. Let's get the coupon. I don't know if y'all noticed, it looks like markets are okay today, right? It's Revelation Day, but he spoke after markets closed. After markets close, markets are down 2% and after hours. So I don't think they liked what he had to say. They're not showing futures here yet, but they will pretty soon. I think his face expresses what the market is thinking right now. So it doesn't look like they like it, but we'll see. They're going to start assessing it and figuring it all out. So it's going to be interesting. All right, so let's do Treasury yield curve. So we're talking 10 years ago, right? So 10 years ago, it was a 30-year bond. So that would be the risk-free rate 10 years ago. The risk-free rate 10 years ago was really low, 253. And then what kind of spread will we put on that? So what was it rated when it was issued? It was rated single A 10 years ago. So single A 10 years ago, single A in March 2025, March 2015, 107 basis points versus 106 today. That's pretty amazing, right? So the coupon was 3.6% back then because the spread was 107 as a single A rated, but today triple B spreads are 106. So even though they got downgraded, the spread didn't change because spreads are so tight right now. So it didn't hurt that much. That's the coupon. Let's do the coupon in dollars. $1,000 times 3.6 divided by 2, so 18 bucks. Let's do the yield. So you have the risk-free rate and the spread. Let's say the spread is 110. Let's see what the risk-free rate is. So it's a 20-year bond. So we look at the 20-year. 20-year today is 458. Let's say 4.6%. So this bond price is going to be down, but it's not because that got downgraded. It's going to be down because the risk-free rate is up. So it's kind of a strange bond. You see a bond like this, like, oh man, it's paying 3.6, but yields are 4.6, and it got downgraded. That's why the prices fell. But no, the yield is almost, the spread is almost exactly the same. So let's figure out the duration. So settlement. Let's do maturity. Plus that times 365. So maturity. Come on, Bill Gates. I don't know why it's saying that. Yeah, what did I do? Oh, I did something wrong. That should be plus. That's why it's probably out in the year 18 trillion. So, all right, there we go. I accidentally multiplied when I was supposed to add. So let's do modified duration. So I might give you this on the exam. I'm not going to ask you to calculate duration on the exam, but if you want to show off and do it, you certainly can. Well, in duration, you could probably do it. So settlement is when the bond was paid for. Maturity, the coupon is 3.6. The yield is 4.6. The frequency is 2. So there's the duration of this bond. It's a 20-year bond, but the duration is only 13.65 years. So it's a fairly, a lot shorter duration than the actual maturity. So let's try Bill Gates. We got to do the effective yield. Let's do the actual current yield. So we take the risk-free rate plus the spread, divide that by 10,000, you get 5.7%. Oh, I didn't do the yield correctly, did I? Sorry. That's just the risk-free rate. So I got to do the current yield. So the current yield is 507. So the effective yield, anybody remember that formula? We got to do something before that. But you're right. Divide by 2 to the 2 minus 1. Yeah, pretty close. And then you'll get a number higher than the yield. All right, let's try Bill Gates' approach. So equal minus present value. You can do this in your calculator. The rate here, we use this number divided by 2. Bill Gates doesn't know if a bond's annual or semi-annual. He doesn't care. The number of periods here, it's 20 years, but it's going to be 40 periods because it's going to pay twice a year. The payment is $18, and the future value is 1,000. Now, is this going to be above $1,000, below $1,000? Below. It's a discount bond, right? It's paying 570. And he's paying 360 in a market that's paying 570. So let's try the guess. Here's where the guess is probably going to be off because this bond probably has quite a bit of convexity, a 20-year bond, but let's see. So we do minus duration times the change in rates. So we do minus duration times rates are 570 today. The only time we do the effective yield is when we do the table versus 360 when we started, 27%. So $1,000 times 1 plus that. That looks pretty close, doesn't it? But it's off quite a bit. Why? Because of convexity. See how much convexity is in that bond. Our guess gets a 725. The actual price is 751. Yeah, 26 bucks in convexity. And remember, convexity helps you. Positive convexity helps you in this case. Then we can do the formula. Say, what if we got this coupon, $18 for all of eternity? So we divide it by the yield. We have to divide by 2 because it's twice a year. That's worth 631.579. But we also get in 10 years $1,000, but we don't get this after year 10. So we subtract that out, divide all that by 1 plus the rate divided by 2, raise it to 20th. Add those two together. Uh-oh, I did something wrong. What did I do wrong? Don't know what I did wrong. There's something wrong in there, but oh, I see what I did wrong. What did I do wrong? How many periods are there? 40. All right, so there you go. All right, so that looked pretty accurate. You see the advantage of doing it more than one way because then you know this one's going to be an approximation, but you know these two have to be exactly the same, except for rounding. Small pennies can be there. And then we'll try the table. So we got time, cash flow, discounted, discount factor, discounted cash flow. And we'll even do duration just to see how close we get. This is modified duration. We're going to calculate Macaulay duration, but here we got a cash flow in 6 months all the way out to 20 years. And then our cash flow is the $18. We get that every time until the very end. We get the $1,000 back. Discount factor is the only place we use the effective yield. 1 divided by 1 plus the effective yield, raise the time. So you see, you probably remember 3013. There's 2 ways to handle this. We can use the effective yield and then use actual time, or we use 1/2 of the current yield, and our times are 1, 2, 3, 4. So the first one is really 6 months. So there are 2 different ways to do it, but just give you some practice with both approaches. And then our discounted cash flow, you just multiply across. And when we sum all those up, hopefully we'll get the same answer. Looks pretty close. So what is the duration formula doing? Let's see if I can get it exactly. So let's try this again. But let's not do modified, let's do duration. So that's Macaulay. So Macaulay duration should be what we have. So remember, all duration is you take your weighted average time. Our time here is 6 months, but our weights are discounted cash flows. So we take the 1750 divided by the price. And that's our weight for the first time. You multiply it, you just copy that down. And that gives you the same answer, all right? Now let's see if I can get his modified duration. Modified duration should be, man, I'm not exactly sure how they do it, but we'll try. Technically, it's Macaulay duration divided by 1 plus the current yield. But that's too much. They may have to divide by 2. So that's probably what they're doing. That's the part I'm not exactly sure. I have to go back to Wikipedia. It's been a while since I took the CFA exam. So modified duration is Macaulay divided by 1 plus the yield, but when you pay semi-annually, you have to make the adjustment. It looks like the adjustment is you just do 1 divided by the yield, but divide the yield by 2. And that gives you the 305. I'm not sure those are the exact same numbers. We can see. Yeah, they're the exact same numbers. So that's all they did. So you now know more than 99% of undergraduate finance students. And what is your goal? 100%. So we're not almost there. You're close, but you're close. So most undergraduate students don't know how to do duration. I'm not even sure in John's class how much time he spends on duration. But you're also seeing convexity in here, which puts you ahead of even another fraction of that last 1%. You can see it physically, visually here. So we talked about positive convexity. What is positive convexity? The actual price change is better than the price change you get if you just use duration. And that's what the positive convexity is. And why is that? Well, because as rates rise, duration falls, so it doesn't have as much impact. So you get that a little bit of a positive cushion. And here, because this bond is so long, it's 20 years, you're going to have a much, much bigger impact on that. On the exam, since I'm giving you a 2-year bond on the exam, convexity will have almost no impact whatsoever. So the duration should get you pretty close. We'll try it, test it out and see. All right. I'll try to remember, I might put this out on Canvas or not, but I think the bigger question is, could you do everything I just did in a blank spreadsheet without any notes off the top of your head? So that's what you got to be able to get to. All right. That's when you know it. That's why I love Excel. Students like this on a calculator, all they know is how to push buttons on a calculator, but they don't know what they're actually, if you see how Excel makes you have to know it, because you got to set it up. And the same thing I did with standard deviation and beta and correlation, all those other things. If you can set it up in Excel off the top of your head and do the entire thing without any notes, you've arrived where you need to be. So I encourage you, practice it, try it out. All right, so let's try. This is what the exam question will look like. This exam I did Hormel. So on exam 2, I pick one company and I use it throughout the entire exam. So this Hormel, determine the current price of this bond. It's a 10-year bond issued 8 years ago. Every time on this exam, it's going to be a 2-year bond. I could be a 20-year bond issued 18 years ago or whatever, but you can have 2 years left. Its coupon is 6.5%. Today, it's rated A+. It was rated AA, but you don't care about that. That's going to influence the coupon, right? But I've already given you the coupon, so you don't need to know that. So the first thing is, so some people like steps. If you like steps, let's do this. Step 1. Well, I'll tell you what I'm going to do, is I'm going to build this. I'm going to build this in Excel so I can, but then I'll do it by hand here. So I just want to get the duration. Or our coupon is 6.5%. And our yield. So what is our risk-free rate here? 4.3, right? It's a 2-year bond, so 4.3. And then what is my spread? It's a 2-year bond, and what's the rating?
A plus.
Yeah, so 115. So plus 115 divided by 10,000. So there's my yield. So duration. So we use modified duration because it's more accurate. So we'll use that. So I might give you this on the exam. So settlement, maturity, coupon, yield, twice a year. There's your duration. All right. So the duration is 1.86. So step 1 is determine the risk-free rate. So we already got that. It's a 2-year bond. It was a 10-year bond. So that would have been the risk-free rate if it were a 10-year bond, but now it's a 2-year bond. So that's 4.3. And I recommend on the exam, don't use percents. Do everything in decimals. Step 2, determine the spread. Again, it's a 2 years, A plus. So that's 115 divided by 10,000 equals 0.0115. Step 3, determine current yield. That's just going to be the risk-free rate plus the spread. So risk-free plus the spread. Step 4, so you need the effective yield. So Amelia, what is that?
5.
Well, give me the formula, yeah.
It will be 1 plus the yield divided by 2 to the power of minus 1.
Good, all right. And you know that's going to be higher than 0.0454. So the effective so I get 552, and you can round on the exam. There's no reason to go out 50 basis points or anything. So 552. Optional. Step 5. Get comparison prices. You got Bill Gates. You got duration. You have formula. These are all optional. And if I do those here, so Bill Gates is equal minus PV. My rate is 545. Number of periods is 4. My payment is, I should have put the coupon in there. Let me get the coupon. Coupon is going to be, well, in dollars is $1,000 times 650 divided by 2. So 3250. So the Bill Gates approach. Equal minus PV. My rate is 545. Number of periods is 4. My payment is 3250, and my future value is 1,000. It gave me a discount bond. That doesn't make sense. So what did I do wrong? Coupon 650, right? The yield is 545.
Oh, you didn't multiply it times 2.
You have to divide by 2, right? I forgot to do that. So remember if you're going to use your calculator, make sure the rate is the rate divided by 2. Okay. Now that you see why it's good to know if it's a discount or premium bond before you start. Then you know pretty quickly if you made a mistake. All right. Let's try the duration approach. This one should get us pretty close. So we take minus duration times and change in yield. So yields today are 545. They were 650. So we're going to have a gain this time because rates fell. So we take $1,000 times 1 plus that. And it's pretty darn close, isn't it? It's only off 13 cents. So that's a pretty good estimate. Then you have the formula. I don't know. I have had students do the formula on the exam. So the formula says, hey, what if I got this 3250 for all of eternity? My discount rate's 445. I've got to divide by 2 because it's twice a year. But I'm not going to get that. Instead, in 10 years, I'm going to get $1,000 minus that. So if I discount that at 1 plus the rate divided by 2 raised the 4th, add those two together. Does that look close? It's pretty good, right? You're feeling pretty confident. And then you did the table and you get $1,087 and you know, okay, you did something wrong in the table. So you don't have to do all of them or even any of them. These are all optional. And then step 6 is create table. So let's do the table in here, and then I'll bring the table into this. So for the table, got time, cash flow, discount, factor, discounted cash flow. So not much time here. Cash flows are 3250. Except for you get $1,000 back at the end. And then your discount rate, 1 divided by 1 plus. Here, use the effective rate. The only place we use the effective yield. Raise the time. Sum those up. And now we're really confident. Does this bond have positive convexity or negative convexity? And how can you tell it's positive convexity? Duration gave you the lower price. That's what positive convexity means. The actual price is higher than what duration tells you. Not much, 13 cents, but on a 2-year bond, you don't expect much convexity. And rates didn't change that much. They came down about 100 basis points. So it's not, well, duration does a pretty good job if rates didn't change more than 100 basis points. So this one is going to be, it's a short-term bond, doesn't have much convexity to start with, and then rates didn't change all that dramatically. So, all right. You bring the table in. Uh-huh. Well, these are all 3 of those are optional. The only difference is from the exam questions I'm gonna start, if I remember, putting duration just as a gee whiz number into the question in case you want to do it. You can ignore it if you want to, but it's going to be there. As a finance major, everything I just did should just be second nature. This should be something you're really comfortable with. It's something we do all the time in finance. So if you forgot it after your 3013 class, go back and relearn it because it's important stuff. All right, let me save this. It's out there, and I'll try to remember to put it out there on our. This isn't a team question. Now, what you'll notice with bonds, I get this question a lot. You've got a bond. Let's start with this one. You've got a, well, let's see. I want a radical one. All right, not that one. All right, you got a bond that's paying you 4.9% and a market where bonds are only paying 4.23. Should you sell this bond or hold on to it? So if you sell the bond, you'll get an extra 54 bucks. But then you go out and you're going to buy another bond to replace it. What's that bond going to be yielding? 4.23. If you take that extra 54 bucks and you bond that pays 4.23, what you end up with? You end up making 4.9. You can keep the bond and make 4.9, or you can sell the bond, get an extra 54 bucks, invest in it, and end up doing what? Making 4.9. You're going to get the same return, right? This 54 bucks is doing what? Making up for the difference. What about here? You got a bond that's only paying 2.25, and the market's paying 3.96. You say, man, I'm going to sell this bond and get a higher yielding bond. Is that going to work? If you sell this bond, what's going to happen? You lose 80 bucks. So when you invest that 920, you don't have $1,000 now, you only have 920. You invest that at 396, what do you end up getting as a return? 220. You're stuck with this yield because that's how the bond is priced. You're going to keep getting that 220 because the $80 you lose is going to bring your return down from 396 to 220. What else would you consider? If you sell this bond for a gain, what else do you have to worry about on April 15th? Capital gains tax, right? You have to worry about taxes. If you're going to end up with the exact same return, you have to say, do you want to pay your tax today as a capital gains tax? Or do you want to pay tax on 4.9% ordinary income tax? If you sell it today, you got a $50 gain, you got to pay tax on that this year. If you keep the bond making 490, you pay this tax out over several years, but you can be paying as ordinary income, not as a capital gains. So it all depends on how good your tax attorney is, which of those should do. What should you probably do? Probably just hold on to the bond. All you're gonna do is sell this bond, this 30-year bond, and buy a 20-year bond. You might as well just hold on to the 30. You can't come out ahead on this. Now, if you know interest rates are gonna rise tomorrow, yeah, sell it today, but don't buy one today. Wait and buy tomorrow. That's a little bit different. That's market timing. But to sell it today and buy another one today, you don't come out ahead. All you're doing is substituting capital gains for income. So that's the way the bonds are priced. Everybody's the same that they were off before. If you think the bond is mispriced, on treasuries, you're really making a decision. If you think it's mispriced, that you think rates are going to rise or fall, different than what the market says. So that's really what that is. So how good are you at projecting interest rates? Someone did a study of economists. They want to know how good economists were at forecasting interest rates. And their question was, when they think they're going to rise versus fall, what percentage of the time are they right? You think if it was random, it'd be 50% right, wouldn't you? They think they're going to rise, they're going to fall, 50% would be right. They were wrong 66% of the time. So we're not really good at predicting interest rates. What's the best predicted inflation rates is probably the yield curve. I don't know if y'all have ever bootstrapped the yield curve. I think I've had in the class notes how to bootstrap the yield curve. I highly recommend you learn how to do that because the bond market itself tells you what they think rates are going to be in the future. And that's what bootstrapping is. It's a really cool technique to have. So there's a lot in here. It's really quite interesting, a lot more than we can talk about, but I'd encourage you to go out and look at the forward curve. The bond market is telling you what they think the 5-year treasury rate will be in 5 years or in 10 years. what the 2-year treasury rate is going to be in 5 years. The market's actually telling you that. If you disagree with them, so let's say, well, man, I wish I could show you the math. Watch my videos. I'll show you how to do it. But if you disagree, what the market is saying, you have a choice. You can buy a 5-year treasury today and reinvest it in 5 years at another 5-year treasury, or you can buy a 10-year treasury today. And what the market's telling you is you should be indifferent between those two. So if the market's telling you, I think the 5-year rates are going to rise in 5 years, then the 10-year yield is going to be higher than the 5. So you buy the 5-year at say 4%, but in 5 years, it's going to be 6% or something. That combination, you'll end up with the same return you would have gotten if you just bought the 10-year. If you disagree with the market, you could buy the 10-year treasury and short the 5-year, or you could short the 10-year and buy the 5-year. You could actually, if you think the market is wrong. Now, when economists are wrong, what happens to them? They get promoted. But if you think the market's wrong, you can actually bet against it and make money. So if you think the market's forecast for interest rates is wrong, you can make a trade. If you think the 5-year rate is going to be lower in 5 years from now, then you would short the 5-year and buy the 10-year. If you think it's going to be much higher than the market thinks today, then you short the 10-year, buy the 5-year, and you would end up with some pretty good gains. Because what's your investment today? If you short the 10-year for $1,000 and you buy the 5-year, your investment is 0. And if you're right and you make $1,000, what's your return? Go back to that formula, right? $1,000 divided, what was your beginning value? 0. What's your return when you divide by 0? You can't even calculate returns. So you got an infinite return there. Oh, you can short treasuries. Yeah. You have to go to your broker to make sure they do it. I had a guy here in town, we shorted tips because we thought the tip yield was way too low. Your broker has to find treasuries you can probably do pretty easily. But treasuries, if your brokerage has them, you can short them if you have the contract set up and everything. So yeah, he did it. Yeah. Well, there's actually leveraged short treasury ETFs. I don't know how many typos I have in there. They exist, so you can do that. 20-year treasury bear 3 times. So if interest rates rise so that the 10-year treasury falls 2%, you just made 6% on that. Not only that, but you can buy call options on that ETF, and then you can leverage up the leverage stuff, leverage upside down. I mean, it's getting crazy, right? So yeah, I mean, you can do that. I actually bought one of these short treasury. It wasn't leveraged up, but I did a short treasury. So it was because in 2020 interest rates were so low. So I bought an ETF that was shorting long treasuries. Well, did they give us the ticker on this thing? I don't see the ticker. It should be in here somewhere. They should tell us the ticker, shouldn't they? Maybe that's it. TMF. And we can look. There it is. Let's see. They have options on it. But yeah, they have call options. $2.28. So now this is a call option on a bear strategy. So it's really a put option, but it's a call option because you're buying a call option on an upside down 3 times. So the math gets really, really wacko. So don't ask me questions off my head because I've not tried to do something like this. I'm sorry? What do you mean dataless? Well, this won't, but you could get it off the Bloomberg machine probably. Yeah, Bloomberg has it shows you all the Greeks. Yeah, you could find, someone would have this, or even go to CBOE, they might have it, cboe.com to use their website. They have all kinds of stuff. You can plug in a ticker and they'll give you that kind of stuff. Yeah. Here's the theta. Well, I'm going out to May, right? So I don't. Yeah, I don't know if it'd be that much different than, I mean, you're saying it's a bond, but it's 3 times levered and it's upside down. So it might not be that much different than a stock. I mean, man, it's wild, right? You can buy a call option on something that is bearish. I mean, that it just boggles the mind what that even means. So yeah, it's pretty wild. So you're talking, you use theta, forget theta, just the delta on this thing is, the delta on what? Treasuries or on this actually ETF? What would you want the theta and delta on? Would you want it on the TMV or on 10-year treasuries? What you're more interested in the underlying, right? Your underlying is not that ETF, your underlying is the 10-year treasury. So the math is, it's crazy. It's insanity. On the corporates, here, it's not just what our interest rate's going to do, but you also have the spread, and the spread's rating on the rating. So you might think this bond's mispriced because it's rated incorrectly. You might think this is a single A bond and it's rated triple B. So that's the other way you could find out an opportunity for this bond. So if you think interest rates are going to rise on the risk-free rate, you hold off and wait to buy the bond until the rates rise. Or if you think the bond's misrated, you can wait until it gets rated correctly. So you can make decisions on bonds that are market timing type of decisions or valuation type of decisions. Most bond investors, their only thing they're looking at is the credit rating and credit quality. They tend to ignore risk rate. There's one exception, and that's Lacey Hunt. I do recommend you read his stuff. He's up in Austin. The only thing he bets on is interest rates and treasuries. He doesn't look at credit spreads at all. And that's his whole thing. He's looking at the Fed policy and those things. He has a quarterly write-up that is really, really, really good. It's a little technical, but it's really good. If you go to his website, it's Hoisington Asset Management. Just go to their website. He's got this right at the top, economic overview. And he hasn't done his first quarter one yet, but there's his fourth quarter. He has some incredible charts that he uses. They're really, really good. This is written by Lacey Hunt. I've met Hoisington and I've met Lacey Hunt both. Just really, really great people. But yeah, he has some interesting charts that are really. So he would be one betting on Treasury interest rates. What's the Fed going to do? What Trump going to do? And he'd be looking at all those. He's pretty negative on the U.S. economy versus others. All right, so we'll start on stocks on Thursday or on Monday, and I'm probably going to do another team competition on calculating returns because only 2 teams got even or close, and then we'll do a bond valuation next week as well.